Good morning, ladies and gentlemen. As usual, we start with the benchmark 10-year note, which tends to dictate absolutely everything that happens in the financial markets. This is now beginning to be a very worrying picture. You can see how the Bollinger Bands have started expanding and the market is coming to meet the 200-day moving average, which is very strongly positively sloped. This gives us several possibilities. One is that we break out of this wedge and fall to the 200-day and then have a very quick reaction off it upwards, or that we fall below the 200, consolidate for a few days and then move back down. And if we were to do that, we are looking around a 245 level of yield around the 0.618 retracement of this whole move up, which is definitely in 5 waves. Could this just be a retracement? Yes, it could be, but why now? Why with the market at all-time highs in the equities? Why is this market not following the risk-on rules and therefore going higher in yield as people shift money into risk-on assets from risk-off assets? 10-year yields is a risk-off asset and it's giving us a warning. It's definitely saying all is not well under the surface. Are we any the wiser as to why? No, because all the other risk spreads are very much on a risk-on phase. All we are saying is that this is a very early warning that something is not 100% well. It is not something that we need to jump on at the moment, but at some stage when we get to the 200-day moving average, it'll be a very good spot to buy volatility in the bonds, because either we crash all the way down to 24.40 or we will have a reaction all the way higher. This is a chart of the 10-year note, a continuation chart, which I don't like using nearly as much as yields because of the gaps that are created by the rolls. But even this one, it's pretty obvious that it's telling you that something not quite right is with the market. This is either going to stop at 121 dead and come all the way back down to 119, or it's going quite a little bit higher, probably all the way up into the 123 area, 122 to 123. Puzzling, very puzzling. You don't need to understand why it's happening, you just need to see that it's happening, and it gives you a very important warning that the market is starting to price in something which we don't understand at the moment. If we couple what I've just said about the 10-year note to the VIX, and we enlarge this section of the last couple of or last few quarters, you will see that the VIX was trading basically around the 9 something 10 big figure for weeks and weeks and weeks while the market was rising. Now we're trading at 12%, so the options are implying a 20% greater chance of something happening in layman's terms, and that is something which we don't understand. We would expect the VIX as well to be somewhere around the 9 to 10% area as the market grinds out new highs. That is not what's happening. The market is much more cautious now than it was, let's say, in the last quarter of last year. In the last quarter of last year, the market was very happy and very complacent. Now it is far less so. So people who tell you that the market is complacent, well, they're just not right. The market is at least 20% less complacent than it used to be in the last quarter of last year, as slowly we go into the last quarter of this year. Another warning sign, another sign that the market is not all that enamored with the current levels. Having seen what volatility is telling us, having seen what 10-year notes are warning us about, if we look just at a chart of the SPY, we really are puzzled because we can't put the two together. If we just enlarge this period, we will see how realized volatility, i.e. the range that the market is trading, is very, very narrow. It is very comparable to what was happening in the last quarter of last year. And yet, option pricing is 20% different. The market is trading very well between basically the moving averages supporting it on a weekly basis and the top of the Bollinger Bands. Last week we told you basically the market is going to trade 28.75, 28.80, which is exactly what it did. And this week we can tell you it's going to trade somewhere around the 87 to 90 area, hopefully, and be supported somewhere around the 28.40 to 28.45 area in by the moving averages. Should we fall below it, the cascade is going to be very fast to this moving average, which won't come in until 27.70, let's call it. So what the market is saying is that the dangers to the downside are increasing as the price increases upwards. It is very, very close to the upper Bollinger Bands, and therefore I guess people are building in more of a probability that the market can fall down to below 2800, take everybody out, and then keep on going. And that is probably what the market is saying, is getting more defensive as the price gets higher and higher, because it's saying the market is now running out of oxygen to the upside, i.e. the upside is 10, 15, 20 points and the downside is probably 3 times that. If we look at the fundamentals, which we do all the time, we're convinced that the market is going to trade between the 16 times Blue Angel and the 17 time Blue Angel. That is somewhere around 29, 25, 30 and basically 27, 75, 80. Those are our boundaries that will contain fundamentally whatever curveball is thrown to the market. So it's still bullish, it's still rising. Still the idea is to buy the dip. It's just a question of how big a dip you buy. If the situation politically in the States gets far more tricky, we will see the times 16 Blue Angel, as we saw numerous times this year. And every time it's been a buy, it will be no different this time. It'll definitely bounce viciously off the 16 times Blue Angel. And also it's going to have a very difficult time breaking through the 17 times Blue Angel. So even this fundamental market is telling us that the risk reward as the price rises is deteriorating the whole time. There will be far more downside on surprises than there will be gains on the upside on positive surprises. Now, what I need to warn you about is that absolutely nothing in the longer term picture, in the terms of what the spreads are saying about the risk on this market, is changing. NQ, which is the tech sector, is not giving up the ghost as yet. We warned you last week about the possibility that it might join the dead money sector, but it just not happening. There is a strong possibility thereof. You should be taking some action to mitigate the possibility, but it's just not an imminent factor. We will warn you when it becomes so, but this is not a chart pattern which is incredibly bearish, is it? All the moving averages are wonderfully supportive, and any move back down towards these levels around the 7,200, let's say, are going to get bought very strongly, and then finally down here where these moving averages are around 6,900. This is just normal trading. But as you can see, the market hasn't made a new high. It might make a new high next week, but with the Tesla news, I very much doubt it's got the legs to push through strongly. And therefore, this is a period which is indicating more of a possibility of drawdowns than strong acceleration of price trend to the upside. But yet again, all the spreads are still positive. Last week we warned you about the SOX, Japanese yen, which was just at the 200-day moving average. This week it bounced. It bounced really, really hard. So it's just saying whatever is happening is probably in a compression, but it is not something which is absolutely imminent. It's not something which is happening today, and it's not something that we should be taking action today. We can put some offers above, but it's not something which we need to absolutely panic about. This is basically has been in a wedge since June, and it's just saying it's a continuation pattern. More of an odds that it goes up and breaks higher than it comes down and breaks down, but it's just a warning sign. The 200-day moving average is flattening it out, so another couple of pushes to the downside and we could see something big, but it's just not happening now. This is SPY against the IEF, which is 7 to 10 years. Well, what is bearish about that? Almost nothing. And therefore, it is yet another signal that we might be worried about nothing much, but it's going up in an odd fashion. It's going up because the stock market is actually going up more than the 10-year notes, rather than 10-year notes coming down and the stock market going up. It is a warning, but it's really nothing that we need to panic about now and today. Our risk on, risk off indicator, which we've developed, which is a distillation of all the spreads that we follow, is actually very much in the green. It has been more in the green. It's giving a few warning signals, but it's nothing dramatic. It is still in a very expansionary phase. It would need to drop significantly below zero for this to mutate into some sort of a bear market. It's nowhere near it. This is predictive as opposed to reactive, and there is very much not a lot to worry about at the moment. Well, the dollar last week reacted to the fall in yields, in relative yields between bunds and 10-year notes, which has not broken out of any ranges yet. So what we are saying is, 96.50 is no way it gets broken. There is very good support here at 95.07, but that could give way, and if it does, we'll just enlarge this. If it does, we will be looking to buy 93.63. 93.63, if seen, is going to be a wonderful, wonderful level to get long of dollars, or even get long of long-term straddles, i.e. puts and calls in the dollar, because in 3 to 6 months time it'll either be way over 100 or probably making new lows below 89. That is going to be a very, very, very interesting level. 93.63. That is the level you want to trade. Now, we've gone back through all the periods in history where the dollar traded up to 96.50, and nearly every time you retrace in a three-wave pattern down to 93.63. And therefore, this is completely normal action retracement in the dollar, and something that one should not be worried about in the slightest. But that is a wonderful level to trade. 93.63, ingrain it in your brain. You do want to trade 93.63. We've warned you about XLF, and this is XLF over the very short term and 5 years spread. It is now just getting to be almost ridiculous. The danger to us in the stock market is XLF. And the 10-year note is telling you that the yield curve is actually flattening even more, and there is a danger that it might actually invert. In an inverted yield curve, the banks can't make any money lending. That is what this chart is saying. and the danger to us is XLF. XLF is about 16% of the stock market, and therefore we're not saying it's of the S&P 500, sorry. So we're not saying that we are going to have a crash as a result. So even if XLF came off 10%, that would only be 1% and a bit in the S&P 500. So we're not, absolutely not saying this is the end of the world. We're just saying avoid XLF because the risk reward just is not there. It is always very important to have the S&P 500 sector weightings in mind. You'll see that the technology is 26%, financials are 15%, healthcare is 14%, consumer discretionary is 13%. These are the big ones together with industrials, which are going to decide the direction of S&P. And that is why you get so much churning in the S&P 500, because money leaves one sector and goes into another, and therefore net the S&P 500 does nothing while you get big rotations between these sectors. Still at 15%, if we are saying avoid financials, healthcare and consumer discretionary at least have to take a lot of the strain, if not technology itself. So let's look at the chart of each of those and see who is in a position to take the strain and take the market a lot higher. Daily chart of XLK. Can it go up? Yes, but it's very limited. It can go up 1 to 2% and that's about it. That would be more than enough to take away any losses in XLF. But there again, it is a limited upside chart. If we go to other sectors which are so important, let's have a look at XLY, which is the consumer discretionary. It's done very well. It's above all the moving average. It's in trend, but it is trading right on top of all the daily Bollinger Bands. This is, even if we were to change this to a weekly, we are very, very, very close to some very important levels that it's not going to bust through. Basically, it's saying we have 1 to 2% in the next 2 or 3 weeks in that sector. Again, the risk reward in all these sectors is beginning to be so bad at these higher levels. Let's have a look at XLV. XLV, as you can see, is right on top of all the Bollinger Bands. All these sectors that we have seen are more likely to have an unpleasant shock and a quick move back down of, I don't know, a retracement of 0.382 or 0.50 of this whole move than they are to keep on going up without stopping. That is probably why the market is not happy going up at a rate of clips. It has done quite a bit this month, and it's probably due for quite a period of two-way trade, probably between 2800 and 2910. And at 2875, well, we're not very far away from the top. Even on a very short-term chart, and this is just the the trade in New York in SPX, and these are 10-minute bars, you can see quite how orderly the market is. It's basically trading around this moving average, bullish when above and positively sloping, and you want to buy the levels when it touches it, and basically bearish when it's below it, and basically you want to sell levels close to it and then probably rebuy. But it's definitely a buy the dip market. It is not a gapping market. It is something which is very well supported. We have all these gaps down to 28.20 and another one here 28.57. My guess is these gaps will get filled again over the course of the next few weeks, but that is probably all we're going to get in terms of downside. Don't get blindsided by the performance of individual stocks like Tesla. That has really nothing to do with the S&P 500. A, it's not in the S&P 500, but B, the effect or even psychological on XLK and the Qs
is going to be minimal. Tesla is 0.63 of the NQ, so even if the market went down 100%, which is not going to, it wouldn't take off even 0.6% from the NQs. So don't think that the performance of an individual stock is going to affect the psychology of the market very much. Basically, this market is bid, but it is giving you some warnings. It is saying if you see 2900, you want to get out. In conclusion, our weekly biases. We are, sorry, that's for the 26th now. And what we are doing is we are updating in green, and what we're saying that this situation in the 5s and 10s is unsustainable. There will be big moves either way coming soon, so be ready to react to them. If it falls through that 200-day moving average, things are going to get quite exciting. We are slightly long of volatility in the bonds, in the bond sector. We anticipate that something will be happening. This is what we wrote by the dip: 2810, 2800, 2825, 75 range for next week. Well, almost nailed it to the tick. Now we're saying the market is pushing. It should definitely take out the highs to suck in more longs, but it is running out of gas, and that is the important thing. Don't expect it to give you a great return if you buy it at 28.90, 28.95. It'll probably struggle with the 2900 level for some time, and we'll put that in for you. Struggle 2900. It'll definitely struggle to break it. Don't sell it into a hole. There's no reason to do that. If seen 2805, 2810, excellent risk reward long, as we showed you from the fundamental chart as well. It's not broken 7500 in the NQs as yet. Therefore, the risk of a quick dump is still there. More and more people are getting in sucked long. It's becoming bad risk reward at these levels. We think there is more downside than upside, but there you go. XLF we still cannot get bullish about, simply because we think there will be volatility in the 10-year note. If the 10-year note volatility starts going the other way, then it's a different story, but we can't see it now. We're more worried about the downside. We're very worried about the downside at the moment, and if our prediction of a downside comes true, then XLF is going to be in trouble. VX. What can we say? To us, there is a real warning in this failure of VIX to follow the market. If that is the case, it'll be because XLF has done something bad, and it'll be because the other markets can't sustain the indices with XLF doing what it's doing. That is all we can say at the moment. It's a warning. It's basically saying go more defensive in your allocations. Finally, the dollar. 93.63 is seen, if seen, is a great level for 3-month straddles. We will remind you about that by tweeting. Thank you very much indeed, and tweet you Monday.